Investing in ETFs is easy, you can buy them just like this. But if it's so easy, why do most investors still lose money? Well, the truth is, passive doesn't mean mistake-proof. You might be unknowingly sabotaging your financial future, and it could cost you thousands of euros. So to make sure this doesn't happen to you, here are the top 10 most expensive ETF investing mistakes and how to avoid every single one. And it all starts with one of the most common and most costly ETF investing mistakes: herd mentality. Many people start investing without a clear strategy. They just buy what's trending, what random influencers hype on social media, or what someone recommended on Reddit. The problem? These tips almost never match your personal goals, your risk tolerance, or your time horizon. Instead of understanding what they're actually buying, many beginners jump into niche ETFs like clean energy, AI, or gaming, often after the hype has already peaked. And when the market drops, they panic sell. Don't invest blindly. Learn the basics, know what you own, and don't chase the herd. Build your own plan. That's how you avoid buying high and selling low. Buying high and selling low leads us straight into mistake number 2, trying to time the market. It sounds smart, right? You wait for the perfect dip to buy and then sell right at the top before the next crash. But here's the truth. You might get lucky once or twice, but no one gets right consistently, not even professionals. Financial markets are complex and unpredictable, and by the time news of a crash or recovery hit you, it's already priced in. Jumping in and out of the market doesn't just rack up costs, taxes, and stress. Missing just a few of the best performing days can destroy your returns big time. If you invest $10,000 into the S&P 500 for 20 years, you end up with over $71,000, a 10.4% return. If you miss just the 10 best days, you've got less than half. And if you miss the best 60 days, you lose half your investment. So forget perfect timing. Focus on time in the market, not timing the market. And if you're still looking for a broker, use our calculator to find the best one in Germany. The link is below. And while we're at emotional investing, mistake 3 is investing money you might need soon. It's tempting to invest every euro to chase higher returns, I get it. But here's the danger. If you put your emergency fund into ETFs, you risk selling when the market is down. Unexpected costs happen: a broken fridge, a job loss, or a surprise tax bill. And if you don't have cash at hand, you will be forced to sell your ETFs. So here's the rule. Only invest money you won't need for at least 10 years. And before anything else, build your emergency fund. Right now, you can get up to 2.8% interest with top savings accounts in Europe. Check out the calculator in the description. Speaking of high returns, the next mistake comes from chasing too much return by investing in leveraged ETFs. On the surface, they sound great. If the market goes up 1%, a 2 times leveraged ETF goes up 2%. But if the market drops 1%, you lose 2%. And it gets even worse. The Xtracker's S&P 500 ETF gained 10% over the last year. So how much did the 2 times leveraged version return? Not 20%, not even 10%, it only returned 8.5%. Worse than the regular ETF. How is that even possible? Here's how. Leveraged ETFs reset daily. They multiply each day's return, not the overall trend. So if the market goes up 1% one day and down 1% the next, a normal ETF ends up about where it started. But a 2 times ETF amplifies both moves and ends up below where it began. And these daily swings add up. And over time, leveraged ETFs may fall behind even if the market is rising. That's why they're meant for short-term trading, not long-term investing. So if you want to start long-term investing, but you're not sure where to begin or how to do it right, book a free meeting with us. We'll help you invest with confidence and avoid these costly mistakes. Costly mistakes like the illusion of diversification, for example. Many investors believe that more ETFs mean more diversification and more safety. But in reality, that's not always true. You might hold an MSCI World ETF and an S&P 500 ETF thinking you're well diversified. But both ETFs include the exact same top companies. In fact, they overlap by 54%. Because the MSCI World already contains all the companies in the S&P 500. That's not diversification, that's duplication. True diversification means spreading across regions, sectors, market sizes, and not just owning more ETFs. So you've picked very well diversified ETFs and spread your risk, but then you forget about them completely. That brings us to the next big mistake, not rebalancing your portfolio. Just because ETFs are passive, that doesn't mean your portfolio is on autopilot. Over time, different parts of your portfolio grow at different speeds. ETF 1 might boom while ETF 2 falls behind, or vice versa. Imagine you start with a 50-50 split, and then over time it drifts to 70-30 or even 90-10. If you don't rebalance, your risk profile shifts dramatically. What began as a balanced strategy can quietly and slowly turn into a high-risk portfolio. The fix? Check your allocations every once in a while and bring them back to target. I usually do this by adjusting my savings plans, because selling parts of my portfolio would trigger taxes. And I prefer to avoid taxes when I can, legally of course, just in case Finanzamt's watching. But you know who couldn't avoid paying taxes? Investors who thought they could hold to a single ETF for the rest of their life. That's the next mistake. In early 2025, Amundi merged one of the biggest ETFs, the Amundi MSCI World 5, into another ETF. Thousands of investors were forced to sell, even though they didn't want to. Why? Because the merger triggered capital gains tax. So even if you didn't touch your ETF, you still had to pay taxes, and maybe even sell part of your portfolio just to cover the tax bill. There was one exception. Investors who held the ETF inside a pension paid zero taxes, one of the biggest advantages of retirement plans. If you want to know how that works and what's best for your ETFs, this video is exactly what you need. And speaking about taxes, this is the next mistake. Here in Germany, capital gains, interest and dividends are taxed at 25% plus solidarity tax, and maybe even church tax on top. And yes, even accumulating ETFs that reinvest profits trigger taxes through something called Vorabpauschale, which you can only avoid inside a pension wrapper. The good news? Every investor has a tax-free allowance of 1,000 euro per year if you're single or 2,000 euro if you're married, but only if you set up Freistellungsauftrag with your broker. Taxes are the biggest cost of all. But you know what else is costly? Investing in currency-hedged ETFs. They sound safe because hedged implies protection, but for most long-term investors, they just add extra cost without real benefit. These ETFs charge higher fees and often include hidden costs you'll never see on a statement. And over time, currency movements in a global portfolio usually balance out naturally. Take a company like Apple. It trades in dollars but earns revenue globally. That's already built-in currency diversification. Also, many investors confuse the trading currency of an ETF with the currency hedge. Just because it's priced in dollars doesn't mean it's risky for euro investors. Your broker handles the exchange rate automatically. Unless you're investing in foreign bonds or niche markets, you probably don't need a hedge. Stick to globally diversified, unhedged ETFs and keep it simple. And finally, the biggest mistake of all, never getting started. People spend years trying to find the perfect strategy, the perfect timing, or they wait for the perfect moment. But waiting is expensive. Every year you sit on the sidelines, you miss out on the power of compounding interest, and you give inflation time to quietly eat away at your savings. Some are afraid of doing it wrong. Others think they need to know everything first. But the best way to learn is start. Start small. Start imperfect. Just start. If you're unsure how to begin or want someone to help you start smart, book a free meeting with us. We'll walk you through it step by step. Thank you for watching und bis zum nächsten Mal.